HDFC Midcap Opportunities Fund. This particular fund belongs to Midcap Category. This fund, will it add better return potential or risk potential to your portfolio? Let us analyze. Hi, this is Ramalingam, Certified Financial Planner from holisticinvestment.in. We help individual investors to take right financial decision so that they can reach their financial goals faster and smarter. Before we get into this HDFC Midcap Opportunities Fund analysis, let us first understand some basic points on this midcap category so that we'll be better equipped to analyze HDFC Midcap Opportunities Fund. Here you go, HDFC Midcap category predominantly invests in 101 to 250th in terms of market capitalization. What does it mean? Top 100 companies are designated as large cap companies based on the capitalization. Next to the top 100, 101 to 250 is categorized as medium-sized companies, mid-cap companies. So these mid-cap companies are more volatile compared to the large cap companies. Also will be relatively more stable compared to the small cap companies in the market. As it is an equity fund, this fund is suitable for long term, 5 to 7 years time frame you should have. More than 7 years is preferred. Also, you should have high risk appetite. If you have got lesser risk appetite, then this fund may not be suitable to you. If you are a conservative risk avoiding investor, then this fund may not be suitable to you. On what basis we are going to analyze this fund? That we have to understand. Right? First, we will look at key attributes of the fund. This will be the first segment. In the second segment, we will analyze the return from different perspectives. We will not simply look at what is the past return this fund has delivered. No, we are going to dissect and do a 360-degree perspective analysis on return. Equally important is risk analysis. That is what we are going to do in the third segment. We are going to dive deeper and analyze risk. We are not only going to use the usual traditional method to measure and analyze risk, we are going to use a few unusual, advanced, unique risk analyzing techniques. After all these three sections, we will give you few important observations on this fund. And also as an investor, if you decide to invest in this fund, what you have to do before investing in this fund. That also we will discuss at the end. Now we will move on to the first segment, attributes of the fund. What are all the key attributes of this fund? The minimum investment is 5,000 rupees and for an SIP investor, just 300 rupees. Benchmark index is Nifty Midcap 150. AUM is around 29,000 crores. Expense ratio is 1.73%. Fund manager is Mr. Chirag. And this fund is live since 2007. The portfolio turnover ratio of this particular fund is 17.66. Comparatively, this is a low turnover ratio. Low turnover ratio is actually good for investors because the fund is not having a high turnover ratio. High turnover ratio implies the fund is believing in short-term investing, momentum investing, following the trend. In the long-term wealth creation, all these three can be counterproductive. This low turnover ratio assures that this fund predominantly focusing on long-term investing, predominantly focusing on buy and hold, which is good for the investors. The total number of stocks held in this portfolio, HDFC Midcap Opportunities Fund portfolio, is 66 and the category average is 65. So the fund is more or less having almost same number of stocks. We can't label this fund as over diversified. We can't label this fund also as a concentrated portfolio, right? Whether this neither concentrated nor over diversified portfolio is bringing right amount of risk and right amount of return to the portfolio, we have to analyze. Top 10 holdings of this fund are Bharat Electronics, Cholamandalam, Indian Hotels, Hindustan Aeronautics, Max Healthcare Institute, Balkrishna Industries, Sundaram Fasteners, Max Financial Services, Crampton Greaves Consumer Electricals, IPCA Laboratories. Top 10 holdings weigh almost 38% of the overall assets. 38% of the assets, right? So there is a concentration here. This concentration is going to increase the risk or going to increase the return. We will analyze. Sectoral allocation, top 3 sectors are financial sectors, capital goods, chemicals. They amount to 49% almost of the overall assets. Balance 51% is invested in rest of the sectors. So again, sector-wise also this fund has got concentration. Concentration leads to high risk. At the same time, there's a probability for high return. Exit load is 1% if you are withdrawing before 1 year. After 1 year, there is no exit load. When you withdraw before 1 year, if there is a gain, it will be accounted as short-term capital gain. For short-term capital gain, there is a tax rate is 15%. If you are withdrawing after 1 year and there is a gain, it will be accounted as a long-term capital gain. For long-term capital gain, there is a tax of 10%. Now we have looked at the key features of this particular fund. Now is the time to do analysis on the past returns of HDFC Midcap Opportunities Fund. Return on investment is definitely an important factor for any investor, but understanding return from different perspective matters, so that we will not be just carried away by simple past performance. HDFC Midcap Opportunities Fund in the last 1 year has outperformed the index by 1%. In 3 years and 5 years, almost they have underperformed the index by 2%. In the last 10 years, HDFC Midcap Opportunities Fund has outperformed the index by a marginal difference of 0.25%. So, by and large, this fund, if you look at it, has not outperformed the index. It is an important negative observation on this fund. HDFC Midcap Opportunities Fund, in the last 1 year, it is ranking 9th rank out of 31 total midcap funds. In the last 3 years, 16th rank, 5 years, 14th rank, 7 years, 6th rank, 10th year. For the last 10 years, this fund ranks at 8. So, as the midcap basket itself is low, only 31 funds now, and 10 years and 7 years, it is 20 and less. They are not among the top 5. So, there are other competitors who are doing better than this particular fund. Again, we will do a peer comparison. There you will see this fact. Rolling return analysis is an important analysis. We should not be carried away by the point-to-point returns. When the market is all-time high, a fund may be showing a very good return table. When the market is at bottom, the fund may be showing a very poor return table. So we should not take decision based on just that. So different 1 year, different 2 year, 3 year, 4 year, 5 year period, we have to look at it. And we have to analyze and come to a conclusion. So when we have done analysis since inception, maximum in one particular 1 year period, one of the best 1 year period, this fund has delivered 143% return. In one of the worst 1 year period, this fund has delivered 54% in negative return. In one of the best 3 year period, this fund has delivered 45%. In one of the worst 3 year period, this fund has delivered a 9% return. Best 5 year period, 32%. Worst 5 year period, 0.14%. Now comes the interesting part. Best 10 year period is 26%. Worst 10 year period itself is 10.82% return. That means if you are staying invested for longer and longer and longer, the risk comes down. 10 year and more, the probability for generating long-term inflation beating the return probability is much higher. This fact should give you enough conviction to stay the course throughout 7 year or 10 year time frame. You should not be carried away by short-term returns delivered by this fund. So I will show you, I have given you conviction through this slide. Through the next slide, I'm going to test your conviction. In just one quarter, this fund in quarter 2 of 2014 has delivered 30% return. You have invested a lakh, it has become 1,30,000. 10 lakhs invested has become 13 lakhs. Do we immediately withdraw? Quarter 1 of 2020, if someone would have invested 1 lakh, it should have become 70,000 approximately. If someone would have invested 10 lakhs, it would have become 7 lakhs. You should not lose your heart. In 10 years, this fund has delivered close to 11% return, which is definitely an inflation beating return. Better to stay the course regardless of these ups and downs. Have enough conviction. That will give you patience to ride through these kind of temporary volatilities, to stay the course throughout that 7 year plus time frame. Someone could have invested 1 lakh 7 years back. The present value in this fund would be approximately 2,32,000. If someone could have invested 10,000 rupees SIP 7 years back, month on month, the present value is 13,75,000 rupees. So both in lump sum as well as SIP, this fund has delivered return. However, investing on monthly basis really helps. One side, small installments, you are able to accumulate wealth. Also, this helps you sail through ups and downs of the market and get rupee cost averaging, can work in your favor. Last part of return analysis, peer comparison. How this mid-cap opportunities fund has performed with some of the best mid-cap funds. In the last 1 year, this fund has delivered 3.98% return, whereas other peers like Kotak, Nippon and SBI, they have outperformed this fund. SBI has outperformed this HDFC mid-cap substantial margin. 3 year category, this fund has delivered 18%. The rest of the other 4 funds have outperformed this. 5 year category, again, this fund has delivered 10.52 and all other funds have outperformed this particular fund. Expense ratio is 1.73%, though the assets under management is 29,000 crores. When the corpus goes up, expense ratio should come down. That is not happening with HDFC Midcap Opportunities Fund. We have analyzed the return from different perspectives. We have compared it with the index, compared it with peers. We did rolling return analysis, best quarter, worst quarter analysis. You would have an idea what kind of return this fund is delivering in the long run. Now, it's the time to analyze risk. Why we have to pay equal importance in analyzing the risk is managing the risk is under your control as an investor. Taking a risk is under your control. But getting return or managing return is not under your control. If you manage the risk, the string properly, you will be able to control the return. You will be able to control the kite. So control the string, control the risk in order to control the return and the guide. We will first use few traditional usual risk management tools. According to SEBI's categorization, this particular fund falls under very high risk category. That means this fund is suitable for very aggressive investors, investors who are willing to accept very high level of risk to maximize potential returns over the long term can invest in this fund. Few key ratios to measure volatility and the risk. Standard deviation of this fund is 24.45%. That means this fund is highly volatile. Sharpe ratio of this fund is 0.58. That means this fund has got poor risk-adjusted return. Sortino ratio is 0.59. That means low downside protection. Beta of this fund is 0.96. That means highly correlated with the market. That means this fund takes almost equivalent risk to the market. Alpha of this fund is minus 2.57. That means though it is an actively managed fund, it has not delivered any additional return than the index. In addition to that, this fund has delivered negative alpha. They have delivered less than the index. So it is definitely an important negative observation of this fund. This is an important, unique, advanced, unusual tool to measure volatility. Generally, volatility is measured in total. When a market goes up by 10%, if a fund goes up by 15%, it is also volatility. This will also be calculated as volatility and reported as risk. However, this is an additional return generated. We need not account it as a negative risk. Right? However, when the market goes down by 10%, if a fund delivers 15% negative, that means this fund is falling over and above the benchmark. This is downside volatility. This has to be named as bad volatility or negative volatility. We are going to measure only this bad volatility. We have sorted and ranked all the mid-cap funds based on this bad volatility. When we have ranked all the funds based on this bad volatility, top 25% is high bad volatility, which is not good. Next 25% is upper middle quartile. Again, this is not acceptable. Lower middle quartile is next 25%. Bottom quartile is the least bad volatility fund. So essentially, a fund should be in bottom quartile or lower middle quartile. Fine. So in the last 3 years, this fund is in lower middle quartile. Definitely, it is a good sign. In the last 5 years, this fund is in bottom quartile. Again, it is a good sign. 10-year lower middle quartile, definitely a good sign. 15-year, however, this fund is in top quartile. So there is an inconsistency here. So recently, this fund is able to control the downside risk, but however, it is not sustained. That we have to check up. If they are able to sustain this and deliver better return, then definitely it will have a positive impact. But we have to put on hold and see another 1 year, 2 year return to decide whether they are capable of protecting the downside risk or not. Then capture ratio. This is again an advanced tool to measure risk. When the market goes up, to what extent a fund will go up over and above the index or less than the index? To what extent they are capturing the up market? When the market goes down, how the fund is capturing the downfall? They have to capture less of the fall. They have to capture more of the up market. They have to capture less of the down market. When we look at it, this fund has done an extremely good job when they have captured the downfall. They have restricted the downfall by less than 91%, 91% or less. There the fund manager has got definitely a good hand. But when it comes to capturing the upmarket, this fund manager's ability has to be tested. Because again, here he is capturing less than 91%, which is not good. Because of this, the overall capture ratio is close to 1%. So this fund is almost giving you kind of index return after paying expense ratio. So that we have to look as a negative observation on this fund. Now we have completed the risk analysis from different perspectives, traditional tools and advanced tools we have used. As we have completed all the three segments on the analysis, now we are going to look at few important observations. This fund has got 15-year history, so we are able to do reasonably a good analysis. And this fund, though struggled to outperform the benchmark in the long run, in the short run, this fund has relatively delivered better return. Alpha of this fund is considerably negative. So it is an important negative observation. There are other peers which have outperformed this fund. All these things we have to look as a negative observation of this fund. Now, if as an investor, if you have to invest in this fund, there are a few important things you have to keep in your mind. One, invest only your long-term money. Long-term here means 5 to 7 years. Don't invest less than 5 to 7 years. If you got short-term money or if you are investing for short-term, medium-term goals, this fund is not suitable for you. Next thing, couple of things you have to sit with your financial planner and do. That is, check with your financial planner. In your financial plan, based on the investment objective and risk profile you have got, this fund will fit in or not. Then number two, whether this fund has got good qualitative parameters like institutionalized investment process. Even if the fund manager quits, moves out, the fund will continue to deliver. Some funds underperform all of a sudden when the fund manager quits. Also, whether this mutual fund company is consistently following their investment strategies, or are they frequently changing? At times, a mutual fund may say, we will follow bottom-up approach and we will not time the market. Suddenly, when we look at their portfolio, they would have timed the market. They would have followed the top-down approach. Because of the market situation, they would have tempted and they would have done all those things. Consistency of the strategy is more important so that probability can work in their favor. If they move between one strategy to other strategy, that means they are not having any strategy at all. So get a report from your financial planner on these qualitative parameters. Also, one more important customized report you have to get from your financial planner before you decide. You already may have a mutual fund portfolio, 5-6 schemes, equities. Also, you may have direct equity portfolio. Now, when you are adding this HDFC Midcap Opportunities Fund to your portfolio, whether HDFC Midcap Fund is bringing unique set of stocks to your portfolio, or there is going to be a huge overlap of your existing stocks. If there is going to be predominantly overlap, is it good or bad? Get a report from your financial planner. After doing all these things, you can consider investing in this fund. If you have any further questions related to this fund or any other investment options or achieving your financial goals, feel free to book a free appointment with our certified financial planner. To book a free appointment with our certified financial planner, we have given you a link below this video in the description. Also, we regularly organize insightful investment webinars regularly with investment experts. During the presentation, you can interact with the investment experts and you can ask your question to them. They can answer in the live webinar. This webinar is completely free to you. Again, I have given you one more webinar link below this video in the description box. You can click that link and leave your name and email ID. We will send you the invite for the next webinar. Hope you like this detailed analysis. I'll again meet you in yet another useful video. Thank you. Bye-bye.